Hi everyone, it's John Mitchell, and in this video we're going to continue looking at the 6 types of businesses that are in our study design, and more specifically we're going to look at 2 types of companies. Now, to create a company, the business needs to go through what we call incorporation, which is the legal process of actually creating a new corporation. Now, during that process, the company name will be registered with the Australian Securities and Investment Commission. And once that's happened, the company is created. It has a separate legal entity to the owners. Now, that's very different to what we looked at in the previous video with the sole trader and partnerships. They had the same legal entity, but with a company, the owners and the company have separate legal entities. And that's very important. Now, the company is then divided up into shares. The owners who own the company nominate how many shares they want to purchase. They pay for those shares, and therefore they become owners in the company. And the owners are therefore called shareholders. Now, because there is a separate legal entity between the owner and the business, the owners have limited liability. So limited liability is where the shareholders are legally responsible for the debts of a company, but only to the extent of the nominal value of their shares. So essentially the amount that they can lose is the amount of their initial investment. Their assets are personally protected. So if we have a look at our scenario that we used in the previous video with the greengrocer, they may have taken on debt by, borrowing from a bank or having credit with suppliers, or possibly someone sued them for slipping over in their store. Now, it's the company's responsibility to pay off those liabilities. If the company doesn't have the money to pay off those liabilities and can't sell assets to pay off those liabilities, then it is not the owners or the shareholders' responsibility to do so. All of a sudden, because they have limited liability, yes, the company can go bankrupt and fall over, but the personal assets of the shareholders is therefore protected because they have limited liability. So the first type of company we need to look at is a private limited company, which is an incorporated business that is owned by up to 50 private shareholders. Now, a private limited company is controlled by directors. It's owned by the shareholders and therefore controlled by nominated directors. Those directors will often be major shareholders, but they don't necessarily have to be, but they often will be. Now, shares cannot be freely traded to the public, so they're not available to the public. If you or I just want to purchase a private limited company, we can't just go somewhere and purchase them. In order to purchase shares in a company, it has to be approved by the directors, and so therefore they can choose and select who they actually want to own the private limited company. As we mentioned before, as with all company structures, the private limited company has limited liability, or the owners have limited liability. And what you'll see after the company name, how you can identify a private limited company is you'll see Proprietary Limited or Pty Ltd after its name. And one of the largest private limited companies in Australia is the Cotton On Group. So if we look at some of the advantages and disadvantages of a private limited company, we mentioned earlier that limited liability was a real advantage for the owners or the shareholders of a private limited company. So their personal assets are somewhat protected. And also the company pays the company tax rate, which is, once a certain level of profit is reached, is actually lower than the income tax rate that the other structures we looked at with a sole trader and partnership, where they have to pay the income tax rate. So depending on the level of profit, that can be a real benefit. Also, the life of the company can live longer than the directors. So once the directors pass on, then the company still lives on because it is a separate legal entity to the owners. And also it can be easier to attract more capital than a sole trader and partnerships, especially a sole trader. But because they can sell shares to other investors, then it can be a little bit easier to attract that finance. Now, moving on to the disadvantages. It's more complex and more expensive to establish than the sole trader and partnership structures. There's also more reporting requirements to the owners and to the government that the owners have to sort of do each quarter. And also the shares cannot be traded freely, which, look, you could argue that that's an advantage, because then therefore the directors have control over who owns the company. However, it's not as easy to attract finance like it is with a public listed company, which we'll get into a second, because they can't sell shares just to anyone in the public, or anyone in the public, I should say, can't purchase shares and invest in the company without the approval of the directors. Now we'll move on to the next company structure that we need to look at that's in our study design, and that's a public listed company, which is an incorporated business that's owned by shares, where the shares can be freely purchased and sold on an open market, such as the Australian Securities Exchange, or what you may see as the ASX. And so what happens, like all companies, the owners have limited liability. But here, with a public listed company, there's no restrictions on how many shareholders a company can actually have. So in the previous one, we've looked at a private limited company. There was a maximum of 50 shareholders. That is not the case here. There's no maximum amount of shareholders that the company can have. Now, when a business decides to actually list on an exchange and make their shares available to the public, they go through the process of what's called an initial public offering, or what you'll see as an IPO. And therefore, once that happens, they're on an exchange, and then the public can actually purchase shares in the company and become shareholders. And what you'll see, if you ever have to identify a public listed company, you'll see the word limited, or LTD for short, after their name. And one of Australia's largest public listed company is Telstra. So once again, if we look at the advantages of a public listed company, we'll see again that the shareholders have limited liability, which gives them that real personal asset protection. And it's much easier now for the company to raise capital. We said that in a private limited company, but with a public listed company, all of a sudden now all of the public has the opportunity to purchase shares in the public once they hit 18 years old, that is. And so again, the life of the company can live longer than the directors because it's a separate legal entity, and also they pay the company tax rate. So these advantages are very similar to what we looked at with the private limited company. Now the disadvantages, they're similar also, but we can almost take them to the next level. So we looked at before with a private limited company that they are, complex and more time consuming or expensive to establish. That's true again here, but it's on a far higher level. So they're highly complex and time consuming to actually establish and list on a public exchange. And there are high establishment costs when doing that. And there's lots of legalities about going through an initial public offering. Now, there's also more accountability and compliance that a public listed company needs to adhere to. So anything that is going to impact the value of that company that the directors know about, they need to notify the market so that the market is well informed about the future direction and the future prospects of the business, so that they can value the company and decide what they're going to purchase or sell shares. And also there's possible loss of control, because now the directors don't have to approve a particular shareholder to purchase shares. They're open to the public. So if someone comes in and decides to buy a large portion of the company, then there's the possibility that they can lose control, or at least some control over that company, because they can't control who is purchasing shares and how many shares or what percentage of shares they are purchasing. And so that's the two company structures that you need to know about in our study design. So for questions, activities, and to find out about our Unit 3 Flying Start lectures, then come on over to teachingbubble.com.